Welcome to CoreLogic's overview of the Australian housing market for April 2016. Over the March quarter, we saw the total value of Australian real estate reach a record high of $6.5 trillion due to a combination of further capital gains and new dwelling construction. Dwelling values across the combined capital cities rose by 1.6% over the first quarter of the year, which is almost half the rate of value growth we saw at the same time a year ago, when the March quarter of 2015 saw dwelling values rising by a much higher 3%. The slowdown in home value appreciation has been evident since July last year, when our combined capital city index was rising at the annual pace of 11.1%. Since that time, the annual rate of capital gains has slipped to a 31-month low of 6.4% at the end of March 2016. While the rate of capital gains is broadly slowing, the trends from city to city and region to region are very different. Home values peaked in Perth and Darwin during 2014, and they've since fallen by 4.6% from their respective valuation peaks. Every other capital city continues to see home values rising, at least in trend terms. However, the annual pace of growth has reduced substantially in Sydney, from a recent high of 18.4% per annum in July last year to the current annual growth rate of 7.4%. Also in Melbourne, the annual growth rate has fallen from 14.2% to the current annual growth rate of 9.8%. Brisbane values moved 4.5% higher over the past 12 months. Adelaide values are up 3.2%. Hobart values are seeing some renewed growth, rising by 4.8% over the past year, and Canberra dwelling values have increased by 1.7%. The reason for slowing housing market conditions are varied, but can be brought back to higher mortgage rates, particularly for investment loans, stretched affordability in the largest capital cities, higher supply levels, and reduced rental yields. As housing market conditions slow, we're also seeing a slowdown in the number of homes selling. Year on year, the number of dwelling sales nationally is reduced by 5.3% over the past 12 months, with the largest reductions in the Northern Territory and Western Australia, where the volume of home sales fallen by 23% and by 11% respectively year on year. The states where home sales have risen over the year tend to be the regions where the housing market has underperformed over the cycle to date, but where conditions are starting to improve. Sales have moved slightly higher over the year in Queensland, in South Australia, and also in Tasmania. Despite the slowing conditions, none of our indicators are suggesting home values are set to record a substantial fall. Auction clearance rates are holding reasonably firm around the 70% mark, which is substantially higher than where we were seeing them late last year. Our private treaty metrics are also holding reasonably steady, with discounting rates showing only a subtle upwards trend, while average selling time is higher due to the seasonal rises we normally see over the first few months of each year. Low mortgage rates should continue to drive housing demand, and there's also the possibility the cash rate could move lower later this year. That said, there's also the possibility that mortgage rates could rise later this year outside of any change in the Reserve Bank's cash rate. Or if the cash rate does fall, the full cut isn't likely to be passed on to mortgage rates due to the higher funding costs being faced by Australian lenders. Overall, the outlook for the Australian housing market continues to be one of moderating growth conditions, at least from a broad level. As always, thanks for tuning into the Housing Market Update from CoreLogic RP Data. You can find regularly updated commentary and statistics on the housing market at our website at www.corelogic.com.au.